Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management. Thank you again for joining us this week for our live weekly update that we try to keep you informed of everything we saw last week and everything we see coming up, and just everything that's going on out there in the economy, market, and the world. And of course, as always, keep in mind everything that we cover on here is for information purposes. Always do your own due diligence, or reach out to us at mikeonmoney.com. Always happy to answer your individual questions and how these things might pertain to your particular situation or your portfolio, and give you our insights on what we're seeing out there. So we have a lot to talk about this week. We're not going to cover too much on COVID. We're going to remove that from our weekly updates. Just we'll introduce it back in as it may impact the economy, or outlooks, but right now the focus is mostly on interest rates, inflation, and of course the Ukraine-Russian war that's going on right now. But with that, let's dive into things. So what we're watching for this week is the U.S. trade numbers for February, and also looking for the business services PMI for March, Canadian trade for February, and of course this Thursday we have the Canadian federal budget coming out. So we'll do an update on that for next week after we see what's out there. Most of the things on the table is really what we're looking at as a post-pandemic tax structure. Is there going to be any change to the personal, corporate taxes, anything that's going to affect your potential estate plans out there, or corporate structures that you might have in place. So we'll give you updates on those as we see them come out on Thursday, and we get through them Thursday night, and we'll have some news on Friday. But if there's anything that you do see out there, particularly, do reach out to us. Happy to answer any of your questions after we see those numbers. The stock market's been a little wavery, a little back and forth over the last few days, especially this morning. Mostly just on the as I mentioned, the Ukraine war, but also what's going to be happening with interest rates. Oil prices did rise this morning. They dipped a bit below 100, I believe, on Friday, but still staying really strong. That's going to continue. We're going to have a bigger in-depth conversation in a few moments here around oil prices and what our outlook is. But keep in mind, when we're looking at an inflationary market, energy and materials tend to do well. So we'll dive in a bit deeper into that, but keep that in mind. It's going to be a common theme we're going to talk about. Ahead of the bell, Twitter is in the news. We'll talk a little bit more about this, but it's basically a bit on a run up, about 27% over the past few days, as Elon Musk disclosed that he holds a 9.2% stake in the social media company, obviously making him a major shareholder, and it looks like he'll also be named to the board. Now, that's not necessarily uncommon when you have the single largest shareholder, obviously a candidate for the board, but we'll have to see how that plays out. Obviously, Elon's famous for using Twitter to send out messages and causing some controversy at times. So it'll be interesting to see how he manages with being on the Twitter board, but also being a major shareholder in that company. In the commodity space, as I mentioned, oil continued to rise or bounce back after dropping below a $100 barrel, and renewed supply fears kind of linked to a lot of the Russian sanctions, but also keep in mind we were going into an energy crunch prior to the Ukraine and Russian war breaking out. We've seen oil actually pretty much on a steady rise since mid to late last year. Also going out there, obviously, with the capital markets being a little bit jittery, private equity is pouncing. We're seeing a lot of this, a lot of private equity jumping out to finance, whether it be tech buyouts. We're also seeing it on the mortgage fronts. We're seeing a lot more movement in the private equity market. Investors are starting to look to private equity as well to find, more stable investments. Just private equity reports differently than stock markets, so you do not have that constant daily valuations on your private holdings. Of course, you don't have the liquidity you have in the liquid markets, but a lot of people are starting to look at that for returns through this inflationary period. And as we've talked about, potentially going into a recession, and those numbers are getting higher and higher as we move closer to Q2. Car makers dream of clean green technology for their cars out there, are running into some problems. This is not a new story. Of course, everyone look at electric cars as being a clean alternative to gas running cars, which is true when you think about the operation of it. But there is the challenge of what goes into the motors, the motor magnets with toxic histories. Batteries are made with fossil fuel, and the recycling of them are a challenge. Car manufacturers are really pushing to have their new EV vehicles to be actually cleaner and be what the supply chain wants them to be, and meet all the regulatory requirements and investors' requirements as a green vehicle. That continues to be a bit of a challenge. There are improvements being made out there. Obviously, if that's the main driver for you to be buying an EV vehicle, you'll have to look at the different manufacturers that you're buying from, where they're getting their supplies, and what that looks like. It's going to be an ongoing challenge, and an ongoing debate and topic of conversation for a while. With that wealth news out there, transportation equipment machinery is pulling down the U.S. factory order numbers for February. We've seen a lot of new orders for U.S. made goods, but they fell a bit in February, likely due to shortage of materials. Of course, we have the continued supply chain issues. We're seeing a bit of shift over to service over manufacturing, as that outlook becomes a bigger concern. But we still have really low business inventories out there, still pushing manufacturing numbers. Now, keep in mind, we talked about this last year, pre-Ukraine Russia, but we are going to get to this point where things are going to slow. The orders are still going to be in there because businesses are historically not great at predicting these things, and will keep trying to replenish their inventories, not really looking out at future demand, and will end up in a glut situation. So you go from zero inventories to too much inventories pretty quickly through these transitions. So we'll have to keep a really good close eye on those on the supply chain side of things, to see where businesses all of a sudden have an excess quantity of goods and a drop in demand, and of course, with a rise in interest rate market, that's very possible to happen very quickly. The funds out there, so the hedge funds, we've talked quite a bit about their movement. They got steamrolled a little bit on the steeper yield curve as they make bets as to the movement. We have seen that steepening yield curve. The 2-year and the 10-year yields are quickly approaching each other, and if we get that inverted curve, that's where we're looking at potential pullback in the markets and potential recession. So those numbers we're looking really closely. We do track about 50 different indicators along that yield curve. And currently I think we're sitting around 30 or showing inversion. So as that number rises, the likelihood of that recession gets bigger and bigger. Prosecutor urges jury to convict ex-Goldman banker in a brazen one MDB scheme. So if you haven't followed this, we talked a bit about it last year. Malaysia set up this sovereign wealth fund, one MDB, to invest and help the Malaysian economy, help Malaysian create jobs, and the fund disappeared, right? Like all the money that was put in there were basically funneled through different investments, really causing damage and losing billions of dollars for their economy. And ex-Goldman Sachs bankers involved in all this, and they're really pushing hard for a hard conviction, some jail time, just due to the amount of harm that was done with that fund. Global insurers are planning to ramp up their private equity investment. So this is just the trend that we're seeing with all investors, but the insurance companies are actually out there looking for private equity investments as well, as they see continued rise in inflation coming for the next year or two, and that effect on the monetary policy that they're going to see out of the US Fed. So you'll probably see us talk a bit more about private equity investments over the next little while. This is definitely an area, if you're not familiar with, do reach out to us, because private equity, as I mentioned, does vary in liquidity dependent on your situation, how much exposure you might want to have to it, how much exposure you don't want to have to it. Make sure you're reaching out to us to talk to us about your situation before you jump into private equity investments. KKR, Kent confirms a KKR private equity company out there looking to potentially buy Telecom Italia, but they can't talk too much more about their bid until they're finished their due diligence. So they're waiting for the telecom company to open their books and let them have a look at those numbers so they can firm up their bid and get that deal moving forward. So with that, let's take a look at what's going on this week. Coming up in the US, as mentioned, we're looking at the trade numbers. We're looking for pretty good trade numbers for February. It did surge to an all-time high in January, so probably coming off those highs, but still quite strong. The Institute for Supply Management expected to show its non-manufacturing activity index to have rose in March after reaching a pretty good number of 56.5 in the previous month. And the S&P Global U.S. manufacturing PMI number for March is also scheduled to release this week. The Fed Reserve in New York is expected to participate in a discussion around the health of the economy. This goes back to the U.S. Fed and the state Feds really looking to have this balance between inflation, interest rates, and that workforce. If you've been out of the house at all in the last year, you know that the workforce is struggling. Companies are having a hard time hiring, especially in certain area pockets like the service industry, labor shortages everywhere, really driving costs up to try to get workers in and to get them to stay. So, the US, the Fed, and the economic heads around the world are looking how they're going to balance this, how they're going to manage that soft landing. They're still kind of hoping for, but the odds are getting weaker and weaker. And really what we're starting to see is that chance of that recession hit, higher aggressive interest rates in a short period of time. That's going to solve the work shortage, because we're going to get to, we could very well get to a point where, as I said, the supply chain will catch up as demand drops off. We'll see manufacturing. We'll see the low unemployment rate, the high hiring rates start to slow down or turn over quite quickly. Incomes will start to the growth in income levels will start to level off and drop a little bit. That's going to bring down inflation, of course. So we might come full circle to next year where we will be coming out of potential recession. Now, that being said, I don't want to scare anyone. I don't want you to think that that's a bad thing. There's still two possible scenarios that we're going to come out of this. One is the soft landing and one is the recession. But in both cases, what we're looking for is about a 10% drop in the market right now. It is a bit overvalued. All the measures we look at are telling us that this rally that we've seen is a bit premature. We're looking for roughly that 10% pullback. That will be a buying opportunity. And it doesn't matter which scenario. Historically, what we see when we see that 10% pullback is we see a rally. We see a rally off the bottom. When that rally starts to happen, that's when we have to start to decide whether we're going recession or a soft landing. If it's a soft landing, that rally should continue. If it's recession, we'll see another pullback, retesting those lows, and then a move into a bull market after we get through the recession. So that's what we're really looking for. The Feds are out there trying to figure out how they can manufacture that soft landing and keep it very, very short. Brazil's composite service index for March is due to be released this week as well. So we'll keep a look at that as an indication on the emerging markets. Health. As I mentioned, in the US, Musk took a 9% stake in Twitter and became its top shareholder. We'll see how that plays out. JP Morgan, interestingly, is warning of a potential $1 billion loss due to what's going on in Russia and all the sanctions that are going on there. We'll probably see this from a lot of banks at different exposures at different levels. Obviously, if you're looking at investing in the financial sector, trying to get a sense of how much exposure they do have to Ukraine and Russia will be an important indicator as to how their stock's going to perform over the next few months. Exxon signaling a record quarterly profit, not a big surprise there on the oil and gas prices. We're looking at them, hopefully pumping out about 9.3 billion in profits over the quarter. So, again, the energy story remains strong. We still like Exxon; it's still in our portfolios. Starbucks interim CEO has just announced a halt to their stock buyback, and the shares fell on that news. Really, stepping into the role, he's just kind of shoring everything up, getting a better look at the health of the supply chain, trying to see what direction they want to go. So it doesn't mean they might not reinstitute the stock buyback, but they just want to slow things down while they restructure their senior management. On other news stories that we followed in the past, Truth Social, if you remember that's Donald Trump's Twitter competition, I guess, that was supposed to launch. It was supposed to launch earlier this year. Then they had a failed takeoff. It was supposed to, go full throttle March 31st. That obviously didn't happen, and two of the senior execs have quit on that. Basically, no real reason behind it, but kind of walked away from it, and they made an announcement that, of course, it's not going to be launched on time or with the features that they originally had hoped to. So where that leads, I couldn't tell you, but when they first did their SPAC, their IPO SPAC back in the day, we did kind of mention that we would suspect that this would be a very difficult feat to pull off, to come out with a product comparable to something like Twitter that's been out and established for a long time and been built over time, to launch something that's that intricate and involved in such a short period of time. So with that, let's talk a little bit about currencies. So the US dollar's gained a little bit, obviously, with the last meeting being more, signaling more aggressive interest rates. That bodes well for the US dollar. But I'll talk a little bit about the Canadian dollar. So Canadian dollar's been on a pretty good rally. I think we're peaking around 79 cents right now. We do have an outlook for about 82 because, as I mentioned, we are looking at a bit of volatility. We're looking at an uncertain market, and Canada is being viewed as the stable option out there. So if you look at what's going on around the world, Canada looks really good. We have our own resources. We're a good place to buy resources from. So as you see other countries, potentially having to find alternative sources to Ukraine or Russia for the resource needs, Canada is stable. We have a good currency. Believe it or not, the world looks at us that we have a good, stable government. So it is a good, healthy spot to look for risk. So normally we're very global on our investment policies and in our portfolios. We are turning more heavily to the Canadian side of things for all those reasons. And on top of that, the Canadian dollar, is holding in well. And as long as the Canadian the Bank of Canada keeps their monetary policy, so the interest rates in step with the US, we should continue to, our dollar should continue to trade on the strength of the oil price, which, as I mentioned, we really like for the near term and longer term for this year. So with both those things in play, Canada becomes a good favorable currency. We still think we'll probably top out around 82, 83 cents. Against the US dollar, but still a bit more strength in the Canadian dollar to the US as the US stays strong as well. The euro's likely to stay weak as new sanctions go against Russia, which is really driving up their energy prices. So all the inflation we're seeing here, Europe is seeing even heavier because their reliance on those resources from Russia and Ukraine, and as the prices spike up even faster there due to more scarcity overseas. So really the currency plays Canada, US, and Canada obviously a bit more room for growth there. As I mentioned before, the bonds, we're definitely seeing the flattening of that curve with the 10-year rising to 2.42 and the 2-year note rising to 2.44. Keeping that inversion really tight and looking more and more like we could slip into a recession. On the commodity front, as I mentioned on the oil side, really what we're looking for, obviously we have the Russia-Ukraine thing, but let's take that out for a moment. Yes, that is weakening supplies globally, but we were short supply and short inventory before that, and that's the underlying trend that we see playing out here. That will continue. Obviously, there's going to be a little bit of movement on the price on what's going on in Russia and Ukraine. We might see some spikes. We might see a little bit of pullback, but really that underlying trend is still strong. Inventories are nowhere near where they need to be to have that price really start to weaken again. So until we get into a situation where the inventories are building up, oil is still a good trade over the longer term. Gold was flat earlier in European trading. Again, we're looking at the material sector, still strong, still an opportunity there with high interest rates. So with that, if you have any questions, do reach out to us at mikeonmoney.com. Don't forget to you can listen to all our replays in podcast form, or also you can replay this at any time on YouTube. And if you have any questions about a risk play, so an equity play for the next little while, do reach out to us. Like I said, there's a lot going on. If you want to stay risk on through all this, there's certain areas to focus on. We can help you with that and help you with research. With that, thank you, everyone. Talk to you again soon. Thank you. Bye-bye.